Hello and welcome to this special segment in CNBC TV 18. European Union and Vietnam have ratified a free trade agreement which will give the South Asian nation access to 99% of the European Union market in the duty-free mode. This is the first FTA that has been signed and ratified during the time when the global trade arena has been ravaged by the COVID-19 epidemic. And to talk to us about the impact of this free trade agreement and the way forward for India's trade strategy, we are now joined by two experts, Mr. Amitendu Palit, who is a senior research fellow at Institute of South Asian Studies in the National University of Singapore, as well as Mr. Ajay Sahai, who is the DG and CEO of FIEO, which is the Federation of Indian Export Organizations. Mr. Sahai, let me start with you first. EU accounts for 20% of our exports. Now, even before this FTA was signed, we have seen that Vietnam was able to increase its market share in EU significantly. How will this EU-Vietnam FTA impact exporters in India?
In fact, you have rightly pointed out, the EU is my largest exporting market. We export close to $59 billion out of $300 odd billion which we are exporting. And in many of the segments, we are competing very closely with Vietnam. So when Vietnam has signed an FTA, I think we have to be careful in those segments, as over a period of time, we are otherwise also losing some of the market to Vietnam. And therefore, I feel that if we are talking about the footwear, we are talking about the leather saddlery, leather goods, apparel sector, furnitures, marine, tea and coffee. These are the sectors where we have to see how its impact. But one thing is very clear when, for example, in marine sector, Vietnam will be getting the duty preference and will paying 6% duty, or in apparel sector where we will require to pay 9% duty, Vietnam will not be paying the duty. I'm sure Vietnam will be in a position to get more market access as compared to India. And that's definitely, I think, will demand from the side of the Indian exporters also that India should also expedite its EU VTIA very closely, so that whatever little loss of market we are having at this point of time, assuming that this fructify and operate from July onwards or August onwards, we get them back very quickly.
Okay, Mr. Sahai, if you can also tell us the kind of mitigation measures that FIEO is discussing or has raised with the government to ensure that India's share in global trade and exports, that does not diminish in a post-COVID scenario, because as we are seeing, many of these countries have consolidated their trade interests. Some are signing FTAs, others are getting together in platforms like RCEP. What does it mean for Indian exporters? What kind of mitigation measures are exporters thinking about?
Ritu, in fact, if you are looking into the share, I'm not much worried on the share part of that, because global trade also is going to take a huge hit in the post-COVID-19 scenario, and we expect around 30% contraction in the global trade itself. And assuming that India's exports remain in the range of 20 to 25% decline, I think we will be maintaining our share. But for our greater worry is that we are already in the segment where not much trades is happening. And if these countries are taking that much share also, how we will be pushing our employment-intensive exports? Because on the one hand, we are already not in the technology sectors export, whether you are talking about the electronics, electricals, automobile, we are not a significant player now. Even in the traditional sectors of exports, if we are losing to these markets, I think that causes a huge setback to Indian exports, and we have to look into how we can now force different kind of new partnership.
I want to get to Mr. Palit at this point. Mr. Palit, let me start by asking you specifically about this arrangement that has been worked out between Vietnam and the European Union. Now, India has been saying that it will woo companies based in China, which are basically relocating. But a recent Nomura report, for example, has basically said that most of these companies which are relocating actually prefer a South Asian destination rather than India. Now, what is Vietnam doing different, which makes foreign companies go and invest in this Southeast Asian nation, rather than come to a country like India? Mr. Palit?
Ritu, I think one point that is important to be noted is that Vietnam is the second country in Southeast Asia with whom the European Union has entered into a free trade agreement. This is after Singapore. Now, clearly, what this FTA means is, if you look at it from the perspective of Vietnam being not a large economy, but principally a medium economy, unlike India, Vietnam is not being viewed as a market for final product, but on the contrary, from an EU perspective, Vietnam is a country where investments can flow into export-oriented production, and from there, they can access other markets. So once there is a FTA between EU and Vietnam, European producers can invest in Vietnam, and from there, they can invest and export further in other markets in the Asia Pacific, including a market like China, because China and Vietnam are already going to be part of a major free trade agreement through the forthcoming RCEP. So what that essentially means is that if you look at relocation of supply chains, today if production shifts out of China, it makes imminent sense for those businesses to go into Vietnam, because through Vietnam, they can re-export back to China. They can also access the European market through the free trade agreement that has been worked into, and they can also access the rest of the RCEP FTA territory and also exclusively the ASEAN. Where does that leave India? You see, ultimately, if there is a talk about taking supply chains out of China in some part or in whole, but that decision is not based on efficiency grounds, that decision is based on geopolitical grounds, then industries need to be compensated for moving into a location which is less efficient. Now, for a country like Vietnam, given the FTAs that is worked out, it's in a position to offer matching incentives to the same exporters and say that, look, we can offer you the depth of the market across the region and across continents, which practically no other country can. And when that same choice is to be exercised with respect to India, investors would look for incentives, and which incentives need to be primarily of a financial or fiscal nature, because India will not be able to match Vietnam on the level of ground efficiency as far as cost of production is concerned, as well as in terms of the networks that a country like Vietnam has in terms of giving access to final demand markets across the region and all over the world.
So, Mr. Palit, do you believe that India is doing enough to ensure that its foreign trade policy, its foreign direct investment policy, they are tuned to ensure that foreign companies have enough confidence in coming to India and set up base here?
My first reaction to that, Ritu, would be that I think India made a huge mistake by not staying committed to the RCEP. I know that RCEP is primarily looked at as an FTA with China. But today, if you look at the countries with whom India is trying to build a friendship alliance, looking to relocate supply chains primarily out of China for reducing dependence on China, all these countries, Japan, Korea, Vietnam, Australia, New Zealand, are part of the RCEP. The fact of the matter to be noted is that if India had remained with RCEP, India would not have had to search for common rules of origin, which would have facilitated these supply chain movements whenever they happened. It would have had the same set of rules with respect to standards, with respect to investment, with respect to non-tariff barriers. In other words, it would have been part of a bigger family. And within that bigger family, it could have carved out a niche for a smaller family. But today, what India needs to do is to enter into reciprocal arrangements which are going to have to be crafted all in exclusive bilateral fashion. But unfortunately, all these bilateral agreements may not be consistent with each other. Like India and Australia might enter into a CEPA, but the structure of that agreement might be very different from what India might enter into with the US. So what then that leaves India with is basically the hope that the lure of its domestic market will be big enough and large enough for a large number of investors to actually overcome these imperfections and ad hoc, unsynchronized ways of policy connections that India has with respect to the rest of the world, and stick to the attraction of the domestic market.
Mr. Sahai and Mr. Amitendu Palit, thank you so much for joining CNBC TV 18. And we hope that in the coming months and years we'll see a more comprehensive strategy on free trade agreements which covers both goods, services, and investment. Thanks for watching CNBC TV.